So you want to take 15 to 20 years off your retirement curve. You want to cut your taxes by 53% or more, and you want to do all of this without having to manage tenants or toilets. You are in the right place. We are talking about passive real estate investing, and right now is one of the best times in history to be looking at it. The challenge is that it is a minefield out there. There are a lot of things that can go wrong, and there's a lot of people touting a lot of different investment strategies and a lot of different places you can invest. I'm going to go through the 5 things that you need to know before you enter a passive investment, or this is sometimes called a syndication, where you go in with a group of people to buy an apartment building or an asset. There are 5 big landmines that people hit. I'm going to go through them here and explain to you each one in detail so you know what to look for. Now, here's the thing, guys. When you start planning for retirement, you look at your 401k, and we've all seen that growth curve, right? You start when you're 25 and you put in and you put in and you put in, and it starts to grow and grow and grow. But compound interest doesn't really hit till you've done it for 20 to 25 years. Real estate can drastically shorten that very, very quickly because real estate doubles every 5 to 7 years on average, especially commercial real estate. So there are a couple things that we're going to talk about. This is mainly centered on apartment buildings. You don't want to be looking at office space post-COVID. It's just not where you want to be. It's risky. We want to see you in safe performing assets. So what are the 5 landmines? The first thing that you want to look for is that the person that you're going to invest with uses long-term fixed debt. In apartment syndications, that usually means 5 years or more. Usually you want to see 7 years or more. It's really rare to see beyond 15 years with fixed debt on an apartment building. You don't want to see short-term 1-year or 2-year bridge loans. This is what is causing this huge meltdown that we're in the middle of right now. A whole bunch of people in 2020, 2021, 2022 took out 2- and 3-year bridge loans, which either adjust in interest rate or you have to refinance out of. And now because interest rates spike, they're not able to, which is causing them to hand the keys back to the bank, which is now causing a lot of pressure on small regional banks. This is making great opportunities for us that are smart when we enter the market and we buy them using long-term fixed debt, but it's really bad for those people. So in order to avoid this, you want to make sure when you're talking to them, just ask them, what is the debt structure on this? How long is it, and is it fixed rate? The second big landmine is investing in the wrong asset class. So there are a lot of different things out there. I would stay away from development, especially right now. Development does good during an upcycle. Right now, we are in a recession. So 2015, 16, 17, when the market was steadily going up, that's a great time to be in development. But right now, you want to be getting into C-class housing. So C-class housing is where everything goes during a recession. A-class is your executive level housing. It's fancy. It's got the really high ceilings. It's got all the amenities. It was just built. The thing is that it is not going to offer you a great rate of return, especially during a recession. During a recession, people are moving out of housing like that. They're trying to be good stewards of what they have, or they just don't have the money to live there. So they're moving into a lower class housing, which is usually C-class. B-class is the executive housing that is now 10 to 15 years old. It's still nice, but it's not the brand new stuff. C-class is solid working class housing. It's in safe areas. It's in good repair, but it's maybe 15 to 20, maybe 25 years old. It's not super fancy, but it gets the job done, and most people are happy to live there, and it's the most affordable. D-class housing is where you get into war zones, stuff that is 30 plus years old, that's falling apart. It's not where you want to live, but the people that live there have to live there. And then the worst, the bottom of the barrel, is like war zone housing, super cheap, like lots of violence and crime. You don't want to be there at all. Solid C-class housing is where you want to be. I would stay away from offices. I would stay away from development right now. If you want a longer explanation of development, I have another video on that, but just trust me, go for solid C-class housing. That's where everybody goes during a recession. It does very well in every market, but especially during recession. The third thing that you want to look for when you are jumping into a syndication and you're passively investing is, did the syndicator, did the person leading the deal, were they around during the last downturn? So 2007, 8, 9, 10, 11, things were challenging. There was a lot of money to be made if you were an experienced operator. The challenge is a lot of people jumped in 2014, 15, 16, and now we've seen this huge run up. And of course, they can all say that they made money because it was a market that was just going up and up and up. It was super heated. What happens when there's a big challenge? Well, you see a lot of people that took these short-term loans. They're now getting crushed. They're going out of business. They're having to file bankruptcy. You're seeing a lot of people that were active, started in 2014, 15, 16, that now have no idea what to do. I would ask them, what were you doing during the last downturn? If they successfully navigated the waters then, it only makes sense that they would know or have a much, much better chance of doing very well during this downturn. And you want to ask that question. Number 4, you want to look at the fees that the syndicators are charging. So normal fee is a 2, maybe a 3% acquisition fee. If it goes over that, it's a syndicator that is taking way too much in fees. The second thing that can be in there is a marketing budget. It does take money to market this stuff, to get people in. That costs money. And it's okay to have a reasonable marketing fee. A reasonable marketing fee is maybe $20,000 to $40,000 or 1%. Outside of those things, you don't want to see a lot of fees getting added on. This, if you read the fine print on a lot of the deals out there, you'll see that they start tacking on monthly fees or quarterly fees, and you want to make sure that there are not a lot of fees in there. This is how syndicators make a deal look really good, but then when you sign up, you're like, where did all my money go? Why isn't it getting there? Something you can ask for: past returns never dictate future returns, but ask them what their past returns were on investment. If they're returning, somewhere around a 16, 18, 20% IRR, and they've done that consistently, then you know that they don't have a lot of fees. You know that they're giving it back to their investors. The other thing that you want to look for in general is I would say 4 to 6 year window to sell the property. If they're going much longer than that, you're going to be in a really long cycle and you're not doubling your money fast enough. If they promise anything shorter, 3 to 5 years, you saw that during the up cycle. During a down cycle, you're not going to see that. Okay. The fifth thing, and this is the one, it kind of is a subset of fees. You want to look to make sure they have a fixed waterfall. Now, what is a waterfall? I'm going to explain this to you. Waterfall is where we give this return, like a 70-30 return, until the building reaches, let's say we increase rents by 20%. Then the waterfall changes to a 60-40. So me as the investor makes more money. That is a bad setup for you. Just telling you and being really straight. There are a lot of syndicators out there that they start at a 70-30, which is standard. That means 30% goes to the GP, the people find the property and manage it, and 70% goes back to the investor. You want to see that fixed for the life of the investment. But what you see a lot of syndicators do is a 70-30, and then they go a little bit more. They go to a 60-40, they go to a 50-50, and they might even go to a 60-40 in favor of the syndicator, the GP, and they take the money from their investors once the asset starts performing well. You do not want to see that. Now, what the investor will tell you is, well, that incentivizes us to go out and make this property really, really profitable. They're just saying that. Any syndicator wants the property to be really profitable. That's how they make their money. When we do a 70-30 split, when we as the GP make 30%, we do everything we can to maximize the profit there in a integrity, wholesome way. Like we act with integrity. We do everything that we can to make sure that property performs well, but we're not going to take the money away from our investors. So those are the 5 things. To recap them one more time: long-term fixed debt, solid C-class property, They have made it, the syndicator made it through the last recession and thrived and knows what to look for in this one. Number 4 are the fees, and number 5 is a long-term fixed waterfall. Those are the 5 things that you want to make sure of, and where a lot of people go sideways when they get into passive investing. The whole point of this is to make sure that you guys are great stewards of what God has given you, and that you can double your money over and over and over and cut that retirement curve by 15 to 20 years while cutting your taxes by 53% or more.